Choosing between SPY, VOO, IVV, and SPYM is not mainly a tracking decision, it's a usage decision. If you mostly buy the S&P 500 and hold it, the main cost is ongoing fee drag. If you trade it, rebalance it actively, or use options around it, the main cost can shift to execution. That is why these funds are not interchangeable in practice, even though they all give you S&P 500 exposure. So start with one question. Is this position mainly held or actively used? If it's mainly held, the default answer is usually VOO, IVV, or SPYM, not SPY. If it's actively used, SPY becomes much more relevant because liquidity can matter more than the fee gap. Then there is a second layer. SPY is also built differently. It's a trust structure, while the others are open-end fund ETFs. So the first pass map is simple: low interaction, VOO, IVV, or SPYM. High interaction, SPY. The rest of the video is about where that default answer holds and where it changes. At the exposure level, this comparison is narrow. All four funds are built around the S&P 500. You're not deciding between different market views. You're deciding between different wrappers around nearly the same large cap US equity exposure. That matters because it removes a common source of noise. This is not a sector bet. It's not active management. It's not factor design. The relevant differences are structural and implementation based. Start with fees. Current issuer pages show SPY at 0.09%, VOO at 0.03%, IVV at 0.03%, and SPYM at 0.02%. For a long-term holder, that gap is not theoretical. It stays attached to the position every year. That immediately creates one clean conclusion. If your position functions as stable core exposure and you don't need to trade it much, SPY begins at a disadvantage. You need a reason to accept the higher ongoing drag. Remove branding, history, and familiarity. If it's mainly held, recurring cost becomes the dominant friction. That moves the decision away from SPY and toward VOO, IVV, and SPYM. Now we move from headline cost to structure. SPY is a unit investment trust. IVV and SPYM are open-end funds under the Investment Company Act of 1940. VOO is an ETF share class of Vanguard's 500 index fund, which is also a 1940 Act fund structure. Why does that matter? Because SPY's trust structure comes with constraints that do not apply in the same way to the open-end fund versions. State Street's own material on ETF structure notes that UITs typically cannot reinvest dividends before distribution and generally hold that cash until distributions are made. Also note that securities lending is not available in the same way for SPY's structure. For a serious retail investor, the practical point is not to obsess over the legal label. The practical point is that the structure can create small but persistent differences in flexibility and portfolio management. Open-end fund structures are generally cleaner for plain long-term exposure maintenance. SPY's structure is older, highly functional for trading, but less elegant as a pure hold forever wrapper. This doesn't mean SPY is flawed. SPY's position role matters. If the role is tactical access, SPY is still very strong. If the role is efficient long-duration exposure, the structural case tilts towards the open-end funds. This is why many investors get this wrong. They compare only the index name and the brand. The better comparison is role against structure. Core holding versus liquidity tool. Exposure maintenance versus active use. The answer changes when interaction frequency rises. If you buy once, add on a schedule, and rarely touch the position, a few basis points of annual fee matter more than trading spread. But if you trade often, rebalance in size, write options, hedge around events, or need very clean intraday execution, realized trading cost starts to matter more than fee drag. State Street's current SPY page shows a 30-day median bid-ask spread of 0%, and its materials continue to position SPY as the most liquid S&P 500 ETF benchmark for execution flexibility. VOO and IVV also show extremely tight current median spreads on issuer pages. But SPY remains the dominant trading vehicle when investors care about secondary market depth, very high volume, and tactical flexibility. That distinction matters because visible spread is only part of the execution quality. If your order size is meaningful relative to displayed liquidity, depth matters. If timing matters, depth matters. If you use listed options heavily, market ecosystem matters. So for that investor, the higher fee can be a rational trade-off. not because fees stop mattering, but because they stop being the dominant cost. For a low interaction investor, the main friction is ongoing drag. For high interaction investor, the main friction can become execution. If SPY drops out, the remaining decision is narrower than it first appears. VOO, IVV, and SPYM are all built for the same core job, maintaining S&P 500 exposure inside a long-term allocation with limited need for intervention. For that investor, the comparison moves away from trading utility and toward ongoing drag, structural simplicity, and implementation fit. Once you're comparing these three, you're already in the right category for a low interaction holder. This is not a case where one choice is structurally right and the others are structurally flawed. The decision is mostly about picking the cleanest low friction wrapper for the way you actually run the portfolio. VOO and IVV usually sit in the standard default position because they're widely used, very established, and priced at the low fee end of the category. SPYM pushes the fee slightly lower, but this is where discipline matters. A lower fee is relevant, it's not automatically decisive. The fee gap between these three is small enough that the answer can still come down to platform fit, account structure, and how the position is maintained over time. If your portfolio is already built around Vanguard workflows, VOO may be the cleanest implementation. If your broader ETF lineup already sits with iShares products, IVV may keep the portfolio simpler operationally. If your priority is minimizing fee drag while still holding a very large, liquid, plain vanilla S&P 500 ETF, SPYM becomes a very rational choice. There are also several variables that sound important but usually do not change the answer. First, short-term tracking differences are often overstated. Over a brief period, one fund may look slightly better than the other. That can happen because of index implementation details, cash handling, securities lending, or timing effects. For most long-term holders, this is not the real decision. The real decision is which structure you can hold cleanly and consistently over time. Second, fund size matters only up to the point where the ETF is already large and liquid enough for your use. Once that threshold is passed, more size is not automatically a better outcome for a typical retail holder. It may matter at the margin for very large orders. It usually doesn't change the answer for someone building a stable core position. Third, brand preference is not a structural reason by itself. Vanguard, BlackRock, and State Street all run serious S&P 500 products. The relevant question is not which brand feels strongest. The relevant question is which wrapper best matches the role of the position inside your portfolio. And fourth, this is still not a decision about different market exposure. These funds are not separate return profiles in any meaningful strategic sense. You're choosing between different holding structures for the same core exposure. Once that is clear, the comparison becomes more disciplined. So what is the practical default answer here? For a low interaction long-term investor, VOO, IVV, and SPYM all sit in the correct structural category. SPYM has the fee advantage. VOO and IVV remain standard default options because they're deeply established and operationally simple for many investors. The main task is not to find a clear winner. The main task is to avoid paying for trading utility you don't use and to choose a core wrapper you can hold without second guessing. That is the answer for most holders. It changes only when one of the operating variables changes: platform fit, order size, trading frequency, or the role the position is expected to play. There are 4 places investors usually add noise. First, they overvalue familiarity. SPY is the best known ticker in the group. That doesn't make it the best long-term wrapper for every portfolio role. Second, they treat the expense ratio as the only cost. That is incomplete. If you trade with size or frequency, execution can dominate. If you don't, fee drag dominates. The answer changes with behavior, not with preference. Third, they overstate small differences inside the long-term holder group. VOO versus IVV versus SPYM is not usually a life-changing decision. Once you're in the low fee category, you're already close to the right structural answer. Fourth, they ignore role definition. A position should have a job inside the portfolio. If the position functions as stable S&P 500 exposure with limited need for intervention, pick the structure built for efficient holding. If the position functions as a trading and liquidity tool, pick the structure built for active use. That final point keeps the decision clean. Do not ask which ETF is best in general. Ask which ETF fits the role. If this is a long-term core allocation and you interact with it lightly, the default answer is VOO, IVV, or SPYM, not SPY. Their lower fees and cleaner open-end structures fit exposure maintenance better. If you trade the position often, care about options use, or need superior execution depth, SPY remains structurally relevant because liquidity can outweigh the fee gap. If you're deciding only amongst the long-term holder options, the answer usually stays simple. SPYM for the lowest fee, VOO or IVV for very standard core use defaults, and platform fit as the tiebreaker. The correct decision is not about finding a universal winner, it's about matching structure to usage. Continue with the next video, it builds directly on this.